PayPal reported earnings last week and the stock jumped 8%. However, the market sell-off on Friday saw shares slip back under $62, so it is now a good time to buy the dip. Right now, PayPal is trading at a valuation of $65 billion, account for cash, debt and investments on the balance sheet, and the enterprise value is $56.4 billion. Meanwhile, revenue over the last 12 months comes to $31 billion, with $4.4 billion of net income and $6.7 billion of free cash flow. So PayPal stock is now valued at under 15 times earnings and just 8.4 times free cash flow. That sort of valuation is usually reserved for a company that isn't growing, but PayPal is. Revenue in the second quarter grew 8%. PayPal's adjusted earnings per share, which now includes stock-based compensation, is expected to grow 10% this year. In other words, PayPal stock at the current price looks too cheap. If earnings continue to grow at that kind of pace, the payback time would be under 9 years. But PayPal is a widely followed company, so there must be some reason why the stock is not moving up. The first is that PayPal's recent growth has been helped by an aggressive cost-cutting strategy. Operating expenses fell 10% last year and another 2% in the first half. It's unlikely PayPal can cut costs much further, which means its operating expenses will start to grow and that will pressure earnings once again. Another issue is the impact of interest rates. According to management, interest income accounted for about half of transaction margin growth in the first half. That growth is going to fade sharply as the Federal Reserve lowers interest rates, and that will act as a headwind into 2025. The biggest issue, however, is just how competitive the payments industry has become. Transaction take rates are expected to weaken over time, and investors are unsure if PayPal can beat out the competition. Adyen, for example, reported growth of 23% in its most recent trading update, much higher than PayPal's 8%. And of course, PayPal also faces competition from the likes of Apple Pay, Google Pay, Shopify, Stripe, Block and many others. To be fair, PayPal does seem to be holding share. Its Braintree segment is showing higher margins, and new initiatives like Fastlane are helping the business to earn more money from guest checkouts. The company is also rolling out advertising. In other words, it's too soon to write PayPal off, and the current valuation is cheap enough to make the stock look attractive. But these are my personal opinions, not financial advice, and I hold no position in PayPal. For more investing videos, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.